All right, we're going to look at some new or look at some ratios differently, maybe a little bit here. We've seen earnings per share. We saw it a little bit ago at the beginning of this lecture, and it's net income less preferred dividends divided by weighted average shares outstanding. Again, if you need the dividend, we didn't learn how to calculate preferred dividends, so this will be given if you need it. This is the primary gap measure of value, of share value. So this earnings per share can be used to compare value across companies or within a company through time. And one of the most valuable ways to use is in the PE ratio, market price per share and earnings per share. So let's say here's a company has a price of $12 per share and earnings per share of $1. The PE ratio is 12 times. So let's say you forecast $2 per share. Then your basic estimate of market price would be $2 times 12 equals 24. And that's screaming buy. Okay, that's one way to use the PE. There's a lot more to it than that. If it were that simple, and you wouldn't have all these people investing all types of other money to do analysis, but it does go a long way, and it's pretty powerful. There's a researcher, Scheller, who has a PE index that monitors the overall value of the stock market, and he's been able to demonstrate whether the market as a whole is overvalued using PE ratios. Maybe a little more difficult on a firm level for any one company, but they're still heavily, PE ratios are still heavily utilized in finance. Okay, here's some other accounting information. One is dividend yield. So you'll have dividend per share and market price per share. So if a share is trading at 100 and pays $3 per dividend a year, that's a 3% yield. And you could compare that to other stocks and to treasury bonds. So you have a bond yielding 3.16. So yield on a 3% stock is okay, but really only if you expect it to grow. Otherwise, you might be better off with the bond, which doesn't have any credit risk. We can also look at book value per share, which is total stockholders' equity less any preferred equity. Once again, we would give you this given if needed. And book value per share is most often compared to market value per share, kind of like PE. In general, market values are typically greater than book values. However, during the banking crisis, some of the banks' book values went below their market values. Okay, so that's the end of this discussion. In the homework, you'll see you need to calculate ratios. When you calculate these ratios for days, never go past 1 decimal point. For ratios, so let me just say example would be like 32.1 days. For ratios, never go beyond a decimal point. So ROA, let's say ROA equals 4.2. I'll put DSO here for day sales outstanding for that one. And for the percentages, you can either just put, let's see, so gross margin percentage. let's say equals 69%. Actually, let's go to the first decimal point. 69.1% or 0.691. Either way. Okay. So calculating the ratios is pretty straightforward. How do you get the, I guess one thing I'll point out, like if you want average total stockholders equity, you'll need a beginning and ending total stockholders equity, and you divide it by 2. I'm scrolling up to see if I have the balance sheet or not for it. Nope, see this balance sheet just has 1 year. So if you were stuck with 1 year, you'd have to say the average is 21,700. But typically, if you have 2 years, you have the 2 years and divide it by 2. That's how you get the average balance sheet measure. Okay, but the income statement items will just be for the current year. You don't average income statement or cash flow items. All right, so those are the ratios. And again, I guess my other tip is you can print out a clean copy of this lecture and or keep your text page 800 and FF means following. So they put all the ratios there for you on spread out over 3 pages, but it's not any more than 2 pages total. You get photocopy or use your textbook when you take the final.